What's up, YouTube? Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. I don't know if you guys know this place. I swear I did not wear this shirt on purpose. This is from a Seattle, Washington, I don't know, bar. Somebody actually just gave this to me not too long ago, but I didn't do it just because we're looking at a Washington property. I know some of you probably think I put that much thought into my outfit, but I never do. I just happened to notice it when I put the camera on. But anyway, looking at this deal, this is one of those that Lofty. This is on their Twitter. They call it the HELOC style structure, right? And so I knew I had seen them call it that. I couldn't figure out where, and I realized it was um, from Twitter or X. But so this is where it's a homeowner living in the home. They have a first mortgage. They want to unlock some cash, and they don't want to pay off the first mortgage because in this instance, he's got an extremely low rate, 2.85 or something like that. So doesn't want to have to pay that off and refinance, and for whatever reason, doesn't want to get a traditional home equity line of credit. I don't know if maybe those are tough in Washington. In some states, they're easier to get than others, depending on the lending laws. And so instead, moves the property to Lofty and can sell some of the equity, guarantees a specific or annual rental yield where they're paying out, and this is one of the things that always bothers me when Lofty does this, though. They're like, hey, 10% yield and committing to buy back all, or 18% yield, committing to buy back all equity in 10 years. Well, the year one is a 10 or 18% yield, but then it drops down to 12 and a half and then 7.5. Um, so I'm going to do some math and talk about this one. If you've seen me cover a couple of these, you can tell I'm not in love with the structure. Today, I'm not going to do a full due diligence on this property. I'm going to do some math on this structure, and then I want to talk about the opportunity cost, like what are alternatives, why I think this isn't necessarily what I want to invest in. Which reminds me, just because I invest in a property or don't, please do your own due diligence. Don't do it just because I'm doing it. I'm just trying to share the way I look at these things. Some of the deals that I've done so far, I've got one that I'm going to share at the end. It's the Keeler property. I'm going to show you the math. That's closed now, and really fantastic returns. I don't think that it's going to be constantly repeatable, but so far that strategy is working really well, and I've done it. I think now that's the third time, and it's the biggest one so far. And I'm slowly building these up. Hopefully, the Odom one happens this year and will be a very large example of it. But I'm gonna get to that math later and explain why I think that that's a better strategy to use on Lofty in particular. But so what's really happening here? Somebody is, they're selling you the equity, but they have the right to buy it back. And so your return is they're required to buy it back. And so your return is the yield that they pay plus the additional income that you earn when they buy back the um the tokens from you at the end of the process. And so this one, if he buys them back in the first 5 years, he's got to pay $55, and if he buys them back within 10 year at the 10-year mark, or between 5 and 10 years, it's he's going to pay $60 for the tokens. Um, the homeowner is responsible for all the property maintenance. They give us some information about we've got his credit score. We know he passed a criminal background check. Um, Sometimes past those checks is a does that mean he has zero criminal background, or that he has none that they're worried about, right? Like sometimes when you hear stuff like that, I'd like to know more, and I didn't see anywhere that they provided that criminal background check. Um, but yeah, decent credit score, not amazing, but not terrible. I think the owner is a entrepreneur, works in real estate. Sounds like he's very successful from his, let's see, they have you can read all about him, a little bio that they included. So it sounds like he's very successful. It is, but we don't get their income. And so I was talking about the credit score, though. A lot of times, people that are in business or in real estate, don't have great credit scores because they are all, they always have a ton of debt, on properties that they're buying or whatever it is. They might be applying for loans a lot, and there's a lot of things that hurt your credit score. So it is tough to be in this industry full time and have an amazing score. And like, this isn't bad, but it's not, it's not stellar credit either, right? So if I were, if I'm thinking about this as a loan, that's what I want to think about. I want to think about one, what's the collateral? What's the credit look like? And then, what's their ability to repay look like? So we want to look at their income. Those are the big things that I'm concerned about. Uh, we don't get any information about the client or about the lender, the borrower's income. I'm going to say borrower most of the time because, they do say HELOC style. It's not a loan, but they're kind of, it's kind of creating a scenario where it's very much like a loan. I talked a little bit more in depth about how I think that this structure is untested as a loan, and as a, we haven't seen one, at least I haven't seen one, where they've been forced to buy back yet, or a situation where, if this homeowner got behind on their loan, uh, you know, what because they do have like a cross default, right? If they get behind on the loan on the property, we have the ability to claw back their equity, and then we can vote on what to do. So one of the things, if I wanted to buy this, and I'm not feeling really safe about the borrower's ability to repay, and I, like I said, I mean, I don't know. Like it looks like he's very successful, but we just don't get any information about that, right? Um, we know that he's pulling cash out of his primary residence for some reason. I don't even think we get it. We're given the reason for that either. Um, but so if I were going to invest in this, I'd want to look at, well, what can we do with this property if we do have to, if we do have to claw back that equity? I mean, can we kick them out? How would we go about doing that? Um, as far as I know, we've never had to do that, right? Would it be an ejectment action or I think we have a rental agreement, so, well, at least we have rent payment, so it probably would be um, an eviction, but I don't know. It's just it's an unproven structure. It's one that, as far as I know, they've never had to actually litigate. And so, what that looks like, especially in a scenario where there are other creditors, or if there ends up being other creditors involved, um, that put liens on the home, and if that's possible, it probably shouldn't be because this is a distinct entity, right? And he's just a part owner in there. But these are a lot of the questions that I start to think about. But let me get into the math first, and then I'm going to explain why I think about those things. Right. So um, this is the deal. I'm looking at 10 years, right? And so what I did is I looked at if it got repaid at the end of the first year. So this shows like the yield, the 18% rental yield. So you get $9. You make your initial investment of 52.75. It's the $50 token, and then the 275 covers all the fees for the limit order. So it's the 3% fee plus the operating reserve that gets put in. Now, it's probably not fair to count the whole operating reserve because presumably that's going to get paid back out. I mean, I can't, because it says he takes care of all the maintenance. It seems like there shouldn't be any instance where that gets used, and so then you can do payouts with that. So that should boost the return a little bit. There was actually already some discussion in the Discord about that. Um, I'll actually, what if we get rid of that? Well, yeah, let me do that real quick. Let's see. Negative 50 times 1.03, because now that's just with the limit order fee. So if you assume you're getting that all back, your deal ends up looking a little bit better. It doesn't actually change it that much because it's not a huge difference. But I'm just going to leave it how it was at first. But you can see, yeah, maybe that makes it a little bit better. Um, and so this is like in reverse order, right? If in the first year it gets paid back in full, if you get the full $9 in rent, and then at the end of the year they pay it back at 55, um, pay back the $55. Then you get a 21% return. So that would be a decent return, kind of in line with what we're seeing on some of the other properties. But as you go further and further out, because that rental yield shrinks over time, right? You only get 1 year, 18, 2 years of 12 and a half, and then 7.5 after that. Um, that brings you down considerably. If they hold it for the full time, you're getting 10.68%. Now, there's a couple ways to think about this, right? Like, one is I'm locking up my money potentially for a long time because I don't have any control over um, when they buy me out. So, I'm not getting this full, I'm only getting the yield. If I decide to sell early, then I have fees on that sale. It's very unlikely that the token price has gone up, especially once we get into these later years where you're only getting a 7.5% yield. Probably your token price is going to go down by that point, just because of the way people operate on Lofty. And so, you're potentially locking your money up for 10 years, but he's got the right to give it back early. So that's a negative feature for us because if interest rates go down considerably, then we've lost this locked in better profit. And if they go, well, is that true? Actually, we haven't really lost it because, well, yeah, we won't get it in the future, right? Well, whenever they pay us off, it might boost our returns initially, right? Like, ideally, if we get paid back in the first 5 years, or first one or two is looking good, and then it just kind of flattens out towards the end, right? But so I'm locking my money up for a long period of time for what is a lower total return than what I'm getting on a lot of other investments right now, right? Like if I compare this, for example, to properties I'm buying on Mogul, a lot of them have a cash on cash return that are similar to this IRR, and assuming the property does well, could do significantly better. Now, I've heard a lot of people talk about like, oh, well, these are real low risk because it's like debt. And I just don't see that as being an apt comparison for a couple of reasons. One, it's not first mortgage debt, right? We're behind a mortgage. So, like, one of the things I compared it to the other time is I was looking at, investing on ground floor. That's another thing I always forget to mention, or I've been doing better about it. But please like and subscribe. And in the description to this video, you'll see links to all the sites that I'm currently investing on for fractional real estate. Some of them will give you some free money. Just because I invest on there doesn't mean that you should. You should do your own due diligence on the sites and on the individual properties. I'm just sharing, it's the information that those are places that I'm currently buying on. There's also a link to a Discord if you want to talk to other investors. It's been a little quiet today, but we've had a real active conversations a lot in the last several weeks. There's probably 35 or so investors that have jumped in there so far, and it's just growing daily. Just to share ideas, talk about deals, talking about Lofty, ground floor. There's people on there on Mogul, um, Collab, a lot of different sites. So anyway, so one of the things that last time I compared this structure to ground floor, right? Because on there I'm getting my average return right now is 11% on notes that pieces of mortgages that are set to pay off in 18 months or less. So far, so good with that structure. I've been getting paid pretty well. Although I have heard from people that, there are a decent amount of defaults. And so where I haven't seen that yet, but, it could happen. It can drag down your return a little bit. But a couple of things about, comparing this to that those are fix and flip loans or new construction loans. If I compared that to the risk profile of a second mortgage, maybe that's pretty similar. I mean, that's something that you'd really have to think about, by making an apples to apples comparison. But the big difference there is I just keep getting my money back. I think I've had about a third of the mortgages pay off already, and I've only held that, those notes for, excuse me, um, I don't know, 6 months. But anyway, so that's the opposite problem, right? I don't have any lock-in period. But so basically, this what I was saying about this one though is it gives the seller the sort of optionality, right? If rates go down, they're going to be more than likely pay us off early and refinance. But if rates go up considerably, they'll just definitely hold on to this, and then we'll be stuck in it where you could potentially have better returns elsewhere. And yes, you could sell those tokens on the secondary market, but say we get to year 5, we have a 7.5% yield and rates are significantly higher, well, you're going to be selling that at a discount. So, um, not a whole lot of upside in this structure. And I don't know that it is really, because there's an untested legal structure, I don't know that it's really as safe as a lot of people. If I was holding a second mortgage on this property, I'd actually feel a little bit better about um, what would happen if we had to go and foreclose versus clawing back their equity in the manner that we're allowed to. If that gets contested in court, what is that going to look like? It's certainly not the tried and true simple process that we see now with foreclosures. And I say simple. I mean, I've worked on a whole bunch of foreclosures. With a savvy borrower, and bringing in a bankruptcy or something, it can be tough in those situations too. But at the end of the day, it's a relatively safe model where this one, like I said, I mean, maybe it ends up being safe, but it's just completely untested. We don't know a lot about the borrower at the moment. And then I wanted to look at with the requirements, like what is the LTV really, right? So, let me bring this back up. So, okay, he has very low LTV with his first mortgage, right? This is the total. Well, and I did this math off the wrong thing. So I'm jumping around a little bit, but let me show you. This is another one where, let's see, the appraised value was like 1,015,000, I think. Yeah, 1,015,000. And, but it's being valued for this transaction as 1,065,750. He's taken advantage of the full 5% that you're allowed to add as a premium. And so, and he's required to hold 10%, right? He's required to hold at least 10% equity in the property. And so that means if he sold if he sold 90%, and the way, and I believe he doesn't have to own 10%, like $100,000 worth, right? I think it's 10% of the, we have two different types of tokens, right? This is the total tokens, 12,916 represent equity, and the rest represent debt. And I believe what he has to maintain is 10% of these equity tokens. I'm not 100% certain about that. It's one of the things that isn't completely clear to me. But if that is the case, if that's accurate, and he does sell 90%, that's an implied LTV of 98.85%. So meaning he could potentially borrow almost 100% of, and this is 90 of the appraised value, right? And the reason that ends up happening is because of this 5% inflation, right? So by inflating the value by 5%, and then only having to hold 10% of it, 10% of the float of the equity portion, it ends up making it so it could potentially be hardly any, a very, very high LTV where he has very little skin in the game left. Now, from reading the description of the person, seeing his interactions in Discord so far, I don't expect that to be what happens. I don't think he's out here and is going to sell $500,000 worth of these tokens, but that potential exists, right? And so whenever we're thinking about risk, what risk is the fact that more than one thing can happen in the future, right? And some of those things are bad, and so could have negative consequences, and that's what creates risk, right? Is the uncertainty about the future and that certain negative things could occur. And so having the ability to just sell, continually sell equity, uh, and then if you think about it, right, and then having to pay 18% on that, we just have no idea about this borrower's ability to do that. And so that's one of the things that bugs me a lot about this structure, because I see a lot of people talk about it in the Discord as if it's sort of a lower risk structure, and I just don't believe that's the case at all. I think that especially because our recourse is to just take those tokens back, right? I mean, I don't think that there's no um, don't think there's any personal guarantee. Uh, they just they put their token. As far as I know, I'm trying to think about if I saw that. That's the other loan doc. That's this. I don't think that there's any personal guarantee in this. So, I think that the only real recourse is to take the property. And so it's kind of like we are making a hard money second mortgage. Um, I don't know. And so if I'm doing that and I have the potential, most likely somewhere between 10 and maybe mid-teens percent. I don't think he's going to do it and pay it right off the first year. And so we're not getting a huge IRR here. And I really do think that in years 5, 6, 7, those token values would be very depressed. Maybe not because people know they'll get bought out. That's interesting. We'll have to see. Over time, we just haven't seen this very often. But they really get traded more on yield than anything else, and so it'll be interesting to see how much people are paying for um, the fact that they expect to get that $60 payout, within a couple of years. But so if I'm just looking for a fixed income, I'm just looking for reliable income. I'm not, Lofty has not been my number one spot for that, right? I think ground floor makes a lot of sense for it because you are just, buying pieces of mortgages. You can, very easily buy 100, pieces of 100+ mortgages for not a ton of money because you can put a minimum of $10 into each one. So you can get really wide diversification. You have actual liens on properties in a way that is really just a proven means of collecting on your money. And they have a long track record of 10.5% returns or something like that. So that's one place that if I were going to do this and I compare this to that, it just, to me, that seems like a better deal. And then also comparing it to just Mogul, where I'm getting 10+% cash on cash returns on a lot of those deals. Now that, of course, that something could happen in the economy. Something negative could happen where that doesn't, you don't get that. And here it seems like it's a fixed return, right? But it's not. Like something could happen here where we stop getting paid back, and then we do have to liquidate the property, and then you're still only getting, if you ended up liquidating early on, um, you're not getting some big pop up unless there's been some appreciation in the property, right? And if there's been too much appreciation, well, you're not going to get that because that it would incentivize them too much to come up with some other way, to buy it back at the $55 per token. But so yeah, I'm going to talk about opportunity cost real quick and what I think the better opportunity on Lofty. So what I'm doing on Lofty, and if you've been watching my channel, you know this a lot, is deals like this Keeler transaction. So this is one, much a market I'd much rather be in this shoreline market, right? I think it's a better market as far as I'd expect it to hold value better. But I mean, that's just I'm not doing any of the normal due diligence that I do because I've already talked way too long in this video. And I just don't like this structure. And so I'm just basically avoiding these. If that is, if there are people that are really into this and you want to go through like all the regular steps that we do, I'd be happy to. But so yeah, this is one, that was providing no yield. It was it's in a market that I don't love, but it's purely I bought it based on being a significant discount to the real world value of the asset. And I think, when I talk about opportunity cost, you saw that's what I think the real opportunity on Lofty is. So like, okay, if I'm going to invest a certain amount of money on Lofty, and I mean, this is one way to think about it. Really, you should, the other way when I'm comparing it to other platforms, I think it's a more apples to apples comparison, right? Like this deal is more similar to a ground floor deal or even just like a normal traditional real estate yield than it is to buying the discounted tokens on here. But like for me, I want to have some money spread across multiple platforms, right? And so for me, when I look at Lofty, the real opportunity is these discounted tokens. So let me just show you what this one this finally closed. So yeah, I didn't own a ton of tokens in this. I only had 56 by the end. This is right around the beginning of me getting on the platform. So I haven't been, I'm still new, not new to real estate. I've been doing this for 20 years, but really new to a lot of these online platforms. Um, but yeah, started buying. It just was really obvious to me that and these prices are with all my fees included. It's just obvious that the value was here. There was already a discussion, we're going to sell this in real life. So this is just, I just, each purchase, the number of tokens I got and how much I spent. It's a sale. It's actually already sold in the real world. We just haven't gotten paid out yet, and so I'm using these dates for my XIRR calculation, and so I wanted to give myself some cushion. I did this on the last one of these when I showed you the Dresden sale, and I ended up getting the cash actually a decent amount earlier than I had projected, so the returns were even a little bit better than I thought. But so total purchases under $1,500. So again, not a huge amount of money. Still very much in experimenting mode, and also too because it was early, the price of these tokens just ended up going up before I could buy a whole bunch of them. Like I said, the Odin one right now is the one that I'm making a much bigger bet on, and I think I'm expecting it to be pretty similar. So this is the third one I've gone through so far that we is sold in real life and gonna get a redemption and get paid out on. And I think that this strategy uh, is one of the it's one of the best options on Lofty in general. Obviously, not this particular property because it's already sold, but I think this strategy, it's the one that's working the best for me. Followed pretty closely by buying the discounted tokens and on ones that are going to start producing a yield again soon, right? Or so basically buying dips when there's some sort of operational issue, but the asset is perfectly fine in the long run. But so okay, my total sale, my net after everything is going to be $2,105.60, and so $657. Not a ton of money, but I made it sitting on the couch. And very much still just experimenting, especially with these early purchases, and then it just got too much. But ROI over 30% return. In again, first purchase was in September. I ran an IRR where I just said, okay, what if I made all of these, made this whole investment in period one, and then second, at the end of that period, sold it. Okay, that's a 45% return. But then using XIRR, I don't know if you know how to use this, but all it is you put your date range in, you put your cash flows, the ins and the outs, and you get, it spits out. I mean, this is just a ridiculously huge number. It made me wonder if I'm picking things up wrong, but because usually it's not that much higher than the IRR, but I think because this is such a compressed timeline, like I mean that I think it's right. I don't know. Whenever I see something that high, I mean, obviously I don't expect to make 120% returns repeatedly on this platform, but I have made 20 and 30% ROIs pretty regularly with this kind of structure and with trading tokens when getting the discounted ones. So, you know, I think I'm starting to believe and because of compounding, because, this is so far, I mean, none of them have taken more than 4, 5, or 6 months. I mean, this is the longest one so far. Uh, Annualizing these returns, okay, what if I just doubled it, right? And at first it seemed silly to annualize, but realizing now that, I have realized that it is pretty easy to just redeploy the money, within a couple of days. And so we are able to compound it. I think, I think this 45% annual return might be a reasonable goal. I mean, I know that sounds insane. I don't know. It is, but I think it's just because at the moment it's still a really inefficient market. I think most people see this property and get a lot more excited than when they see this, and these pictures actually look pretty good, but when they see this vacant property with no yield in Chicago, like despite the fact that this was, my average token purchase on this, I think was around $24 or something. Um, but despite the fact that it was such a huge discount, there's a lot of people that seem to want to pay full price for a 18% yield on something like this than they do. And part of it might be time, right? Like I think if you don't want to spend a lot of time on the platform, if you buy this and you just want to check in, a couple times a year, maybe this is the deal that makes sense. But I just, I think you're passing up a lot of opportunity by not, doing the discounted token strategy. That's just that's why that's where most of my dollars on Lofty are going, right? They're going to all these ones because when I compare this, right, like okay, even if you just compare to the 30, and then so some people might say, oh, but this is a much nicer asset, so my risk has to be lower, right? But one of the things, and the answer is no. Nicer assets, if you're paying par for each, then yes, the better asset I would expect to have lower risk, right? You're going to attract better tenants. You're going to have, the areas tend to appreciate better. In general, yes, you would think that. But a big part of your risk is built into price, right? And so if like if my $50 is the full value of the asset, and really we know, at least if we believe that appraisal, that it's 5% higher than the full value of the asset, right? And then I'm paying fees on top of that. So really my $50 that I'm spending, or my investment, is worth less immediately when I bought it, right, than what this asset is in real life. So if we had to liquidate today when we bought this one, I'm losing money. The day that I bought this one, if we had to liquidate it that day, I would not be losing money, right? I'd actually make significant money, and it took us a little while to liquidate it. If you had to really fire sale it, yeah, maybe I would break even, right? Like maybe if you just had to sell it for a huge discount to sell it in a month or two, um, you might see that. But if you had to do the same thing, sell this one immediately, you'd have it would be a smaller discount because it's a much more attractive property. So, when I'm thinking about, I really have a hard time understanding where these deals fit into, the overall strategy that somebody would want to use, right? Because if I'm just looking for consistent low risk cash flow, in general, my goal, where I've always gravitated towards for that is debt. And then beyond debt, it's cash flowing real estate in a with a good market, right? A nice asset in a nice market that has a proven track record of producing cash flow. Like that's my next spot for that. Um, and if I'm just trying to get, really good returns, well, then I'm usually doing something a little bit more entrepreneurial or opportunistic. And in real life, that might look like doing a Burr method or flips or lots of different things. But on online, that's very much just become for me. But buying the discounted tokens, buying into the properties that aren't performing well, and working with other owners and maybe getting them rented. I've have I gave you this example. Um, but another one that I think is, kind of interesting that I mentioned, so this is one where it was vacant. We were having a hard time getting the property manager to even like get it ready to rent. We got a new manager. They got it rent ready relatively quickly. We have a new tenant in there. It's not even spitting out cash yet. But I mean, this is a very big, this doesn't $5 pop in value doesn't seem like a ton until you stop and think about like, well, what does that really mean based on this? Like if my $55 token pops $5, that's 10%. But if my 1830 token pops $5 and it's really 498, right? 4.98. Got to do the 1 over X. That's a 27% return, right? So we've got a big pop in value. Now these token values tend to fluctuate a lot. Doesn't necessarily mean this is going to stay here. I actually think this is one that once it starts paying out a yield, which I think it will, it's just a matter of we just got the tenant in there. We're going to pay back the universal lending DAO. We've got to refill the operating reserve. So I think it'll be depressed for a while, but I think eventually this one has the potential to be a high 30s, low 40s token and be providing a yield. And by that time, I'll probably have sold out. Like this one was similar, right? I bought it at the 22, and I had like 120 or 130 tokens at some point. When we did get the spikes, I sold. I bought more low. My actual total ROI on this deal has been ridiculous because I've been able to get in and out of it so much with the fluctuations. It is much, it's a much different strategy, of course. And maybe the return on time isn't there for some people, and that's what would draw them to this. But like again, if that's the biggest thing I'm worried about, then I'm probably going to ground floor or mobile again, right? So it's tough to figure out why this, how where this deal fits in. Like who's the right person, what's the person that this strategy, or what's the goal that this strategy really makes you happy with. And I'll tell you one thing that I thought was interesting. So this guy, he is a real estate entrepreneur. He says he's going to bring some, I think, warehouse to the platform, and I'll definitely look at those deals because I mean that's something we don't really have, commercial property. um I think that so there's already been a lot of discussion with him in the Discord about this property. One of the things that I thought was really funny that somebody brought up is, hey, can I come swim in your pool? And he's like, I would consider doing an annual owners party here. And so that might be, that by itself might be a reason to want to own this, especially if you live close and it's not a flight for you, right? Like, I mean, it might be um, one of the aspects that I completely ignored initially about a lot of these platforms that is now I'm realizing is much more important is they're great networking sites, right? Like sometimes I might buy a piece of somebody's deal that I don't necessarily love the deal, but I think that they're a good operator and I want to, I want to support them on the platform, but also, want to have the opportunity to interact more, get in on some of their other deals, maybe earlier. Some of the people are bringing deals to the site, and some of the other investors are getting in there before it actually comes to the platform. Um, I think there's opportunities like that. And so, maybe I think this guy probably put his home up here because it was the easiest first thing to test on Lofty. I mean, that's my impression, right? I mean, maybe he really needs the cash, but maybe it is just, hey, let me get a property on here. I'll raise a little bit of cash, but I'll get to see what it's like, see how it works. And then I'll bring my real properties on here. I mean, I think that's potentially what's going on as well. So I don't know. I think that's the only, like, other than that, I struggle to figure out like why I'd buy this over actually investing in debt, or if the long term stability is what I was looking for in cash flow, or if I'm just trying to get the best return, you have to ignore this 18% because that's just your first year payout, and then where I think the real opportunity is just these discounted tokens where um you keep just buying them low and selling them high, or buying them low and selling them in the real world, or buying them low and getting them up and running again. And so some of them, because of that, this is, it's a 13% rental yield on this one on my cost basis, right? It tells you on your, like, that's a really it's a better average return than if we look at this, right? Because let's see, what is our average of these? Average of 10 over that full period of time, which makes sense. Is part of how we get to this IRR, and that, the pop in value gives you the rest. Um, and that's not because there's anything special happening at this property. It's that the price point that I got in made it so that yield is significantly higher now that it's just operating the way that it should be. Um, I think that I have beat this topic to death. But if you are planning to invest in this one, and it's not just for, well, if it is for the pool party, please put that in the comments below. I want to know about that. But if that's not, and I don't think that's guaranteed yet, that's just been, floated around. And that was not an intentional pun with the pool thing and floating it around, but I am hilarious, and I'm so, sorry. Sometimes I just can't help it. But if that's not why you're buying into this, but you do plan to buy it, what's the reason? And don't tell me it's because you want an 18% return, because hopefully at this point you realize you're not getting an 18% return on this deal. Um, Or if you think you are and you think my math is wrong. So, oh, that is one thing I want to say. I just broke this out by year, right? I didn't do, I did the XIRR with the dates here, right, of each payment. I haven't been doing that when I do these ones on Lofty Deals because the daily rent would just make it ridiculous, right? I'd have 365 days. I'd actually have 3,650 days over for 10 years, right? And I'm just not going to take the time to do that. So I would expect these numbers to be a little bit higher, but just in case you think it will be like 3 times like it is here, it doesn't really work that way when you have a longer period of time. XIRR just ends up getting really weird when you have a very short time frames. But over this, over a 10-year period, I mean, maybe it would boost it to 11 something. I don't think it's making a huge impact. If you think I'm wrong, that's wrong though, please do the math and show me, and then also please send me that Excel sheet so I can use it for the next one. Um, I don't know. I don't want to totally write off this strategy, but I just don't see the merit in it at the moment. I understand why the owner of this home wants to do it. This is one where, although they are paying a pretty high percent, and I don't know why they'd want to do that. Um, yeah, so please put it in the comments or jump in the Discord and tell me why I'm wrong and why you're going to buy this and it is going to be the best deal. I mean, maybe there's some thought that, hey, I hope he gets behind because then we'll kick him out and this will be a fantastic short-term rental. And, I don't know if that's true or not. Maybe you do some math on that. There are companies out there that are in the loan to own business, right? They make loans hoping they're going to get to foreclose, and then get that asset at a lower basis. So that's a business model that exists in the world. I wouldn't count on being able to use that here. Um, really sorry, this is a 42-minute video. I just can't, please remember to watch my videos on 2x speed. I should have said that in the beginning because I know I talk really slow. But in any case, until next time, I'm going to just keep making mistakes so that you don't have to.